In this video, we'll be covering a unique, complete strategy that most traders aren't aware of. This is a break and retest setup. We'll go over the strategy criteria and give you various examples so you can truly understand how and why this works. Let's start off with a quick summary. We'll cover the basics of the break and retest strategy, including what it is and how it works. Next, we'll go over identifying key levels, which includes areas of confluence like support, resistance, Fibonacci, and fair value gaps. Then we'll dive into the break and retest criteria, which includes trend following, momentum, and confluence. Lastly, we'll go over various examples of the break and retest setups so you can recognize this pattern on your own to make better trades. The first thing you should know is what exactly is a break and retest and what does it look like. If you couldn't already tell by the name of this setup, it starts with a breakout at a certain level. Then following that breakout, it retests that previous level. This is where the trade opportunities present themselves. The main idea of this setup is basically to enter on an old resistance once the market has flipped it to support. Now, it's very important that once the market starts coming back for a retest, you want to enter only if it gives a good reaction. This can be a certain candlestick pattern or a series of candlestick patterns indicating that price action is aligning with the breakout direction. This pattern occurs frequently in the markets and can be found almost anywhere across all time frames and assets. But most importantly, it's one of the simplest trade setups in existence and one of the most successful. And that's why so many new traders love using it, and I think you will too. Moving on, we'll show you how to identify these key levels, where breaks and retest opportunities arise. So on this chart, we can see an uptrending market as it's making consecutive higher highs and higher lows. But if you look closely, you can notice that the market has previously retested these highs right here. It respected the level and moved up higher. Now, since it happened once, we can expect more opportunities like this in the near future. So, assuming that the market is still bullish, you want to mark out this old high that has now potentially shifted to our new support level. In addition, you should also look for other signs of support. Pull out your fib retracement tool and select the swing low that broke this high. Then proceed to select the highest high as your second pivot point. What you'll see here is that the old highs tend to line up together within the golden Fibonacci pocket. And we can also include this fair value gap as a form of support. This is exactly what confluence is, and you should always be looking for it in trading. Basically, various factors that support the trading idea you're proposing. Once you've identified your key level, you want to wait for price to return to this area and enter once it shows bullish price action. So as the market reaches to this area, we can see that it reacts from it and moves up higher. But we still want it to create a series of higher highs and higher lows before we enter the position. This all comes down to patience, a trader's best friend. Now that the market has finally touched our key level for the third time and moved up past this swing high, it has shifted from bearish back to bullish. Another indication of bullish momentum is this fair value gap right here. This candle is way larger than the ones before it. So with the bullish momentum back in action, enter on the retest of the local swing high. Set your stop at the low and target your levels higher. Now that you understand the idea of a break and retest, you need to know the criteria, and that starts with defining what a breakout actually is. A breakout is when price moves above a resistance level or even below a support level with conviction, indicating a new potential trend. Now, there may be times when you have this exact scenario of price breaking out, but then nothing actually happens. It doesn't continue in that direction. In that scenario, traders are trapped in underwater positions. But why does this happen? It could be that it's just a liquidity grab as fuel to move back in the original direction. That's why we need to have our criteria met for the breakouts to be valid, giving us a higher probability of making a successful trade. Our first criteria is to only take trades in the direction of the current trend. If it's bearish, that means we're waiting for the market to break past a swing low. This is potentially turned into a new resistance level, and it's an opportunity to look for a short position. The second criteria is that when the move breaks past the level, it should be with a lot of energy, meaning it has to be a candle or a series of candles that's larger than the ones before it. This shows you that momentum of the current trend is there, and you can be confident in your trade playing out. Now, the final and most important part is to find confluence. So we need other forms or other signals of resistance besides just another swing low. For example, this could be a Fibonacci level, a point of control, a moving average, really anything. And when all of this criteria has met, you're ready to take a trade and watch it play out. Let's put this all together, and we're going to go over some real examples for you. Here we have the gold chart. You'll notice that the market has been ranging for quite a while. We also have equal highs right here, which is where liquidity is likely resting. So price does have a reason to go up higher, and that reason is to take out the highs. After a while, it started moving up with a series of bullish candlesticks, creating higher highs. As price retraced back down, it finds support at this old swing high, which previously was a resistance level. So knowing that the market is bullish, again, we want to look for long opportunities. Here we can see the market breaking above a swing high with a large, energetic, bullish candlestick, your favorite. It then engulfed the bearish candle next to it and made a small, bullish fair value gap. So now we want to select our fib retracement tool and try to find some kind of confluence. Select the swing low that broke the high and the most relevant highest high. Here you'll see that the 0.5 level aligns with our support. When the market retraces back, we'll look to enter a long position with this confluence. All we have to do is set our stop below the low and target our levels higher. Now let me give you an example in a bearish market. We can see that here as price is making lower highs and lower lows consecutively. And here it has created a large fair value gap, leaving behind an inefficiency. So price, we know, will likely come back to fill it. Again, take out your fib tool and place it on the swing high and low to find resistance. The 618 lines up with our resistance level and our fair value gap. So this is our key level. And when price returns to it, wait for bearish price action, like an engulfing candlestick. And then look to enter. Set your stop above the highs and target those sweet gains lower. The break and retest strategy offers a structured approach to trading breakouts, giving you a higher probability setup. By focusing on key levels, waiting for confirmed breakouts, and managing your trades carefully, you can increase your chances of successful trading. That's the whole video, guys. I hope you enjoyed it. If you know a trader that might benefit from this knowledge, please share it with them. Check out the rest of our free educational trading playlist on the channel. And make sure to smash the likes and subscribes on your way out.